just 20 seconds for the opening bell to ring, and it's look like we are going to open with a bit of a green tick. 18,125 is where the Nifty has settled at this point of time. Of course, overnight we saw a bit of mixed cues coming in from across the globe, and there's a Fed event which is lined up for tomorrow. So ahead of that, there might be a bit of a tentativeness, but it's still showing a 60-point uptick as far as Nifty is concerned. Let's see whether that sustains once we open and whether we consolidate around that level or not. So the first rate is out. 18,120 is where the Nifty has opened at. But look at the market breadth. That really is the highlight for me. 1,300 stocks advancing to just 272 stocks declining. And that's telling me that perhaps the mid-cap index and the small-cap index are likely to be outperforming versus the frontline index. Sensex 2 opened with a gain of around 0.3%. A lot of names which are doing well, but sectorally speaking, it seems to be the PSU banking names which are starting with a green tick. You also have the metal names, etc., which are holding up comfortably in the green. Let's talk stock specific and see which are the big movers. Starting with RVNL itself, because it's open with a 5% gain. Adani Green is also sitting higher by around 4% on account of result reaction. Blue Star, which is going to consider a bonus issue come May 4th, is seeing a reaction of around 4%. IDFC First Bank, the numbers were great. Saw an upgrade coming in from Morgan Stanley, so a 3% gain coming in there. Then you also have the likes of IRB and Aarti Drugs, which are reacting positively. Aarti Drugs, of course, reported its numbers. You also had other stocks which are moving on account of the updates coming in. Hero MotoCorp, for instance, is down 3% after the monthly booking failed to infuse the market, so almost a 2 to 3% cut coming in there. RBL Bank, the numbers were a bit mixed, so 2% cut coming in there. Zomato is starting on the back foot today, so 1.4% lower. CEAT, Coforge, all of these stocks seem to be reversing the kind of gains that they had made last week. L&T Financial Holdings is also result reaction. We are seeing a cut of almost 1% there. And SBI Card 2 is seeing a downtick, a mild downtick at that. Not big movers this morning. And even if you look at the volume buzzers, it's the likes of IDFC First Bank. Let's pull up Kotak Mahindra Bank as well, because the numbers were quite solid, but it's just that the market is not giving it a thumbs up, given the fact we have seen that there would be a CEO transition happening. So pretty much flat for Kotak Mahindra Bank. Ultratech Cement 2, wherein the numbers were a bit higher than expectation, should be getting perhaps a thumbs up, or okay, just a flat lining as far as Ultratech Cement is concerned. Let's look at some of the oil marketing companies as well. Reliance Industries, ONGC, MRPL, Chennai Petro. The GRMs had crashed quite meaningfully. So let's watch out for these names as well. Again, separately, Vedant Fashions, wherein the revenue was up around 15%, but the margin was flat. So pretty much flat reaction coming in for the counter as well. Not other big movers that I can spot at this time or at this point, Avan, but looks like Hero MotoCorp, when the numbers were much lower than expectation and the sale was down on a year-on-year basis, is getting a bit of dropping this morning.
Yeah, and then there's Bajaj Auto as well to react to right now, as the April auto sales are trickling in at 3.31 lakh units. I think that's pretty healthy that they've reported, given that we were working with an expectation of about 3.14 lakh units. So that's the total sales number, which has seen a bump up from last month of 2.9 lakh units. Let's get in a view from our chartists then. What's the view, Kunal? What are you looking at on the screen?
So it seems like a good start for the indices. Again, 70 point on the Nifty, but we are closer to that 18,200 mark. So I think the closer we are towards that level, it could be a point where I would look to start booking out profits. In fact, the opening trade which I would be looking out for would be to try and book profits on L&T. That's a stock which I initiated a buy, I think at 2,200, 2,220 levels, almost a week and a half out back. So that's a zone. I think at current levels of 150 points from those levels, it's a good time to try and book out profits and then maybe go back towards the traditional larger cap names over here.
Okay, so that was the first trade, book profits on L&T. Naresh, what about you?
That would be a buy on Tata Power. The stock has done nothing for a long period of time. It's given a small breakout in the near term. So keeping a stop loss at 199 and taking it for a move towards 210 and 230 in the short term.
All right, let's move right on then. And we've got Harsha Upadhyay as well, who's joining in. He's CIO Equity at Kotak AMC, to give us his view on the markets as well as his outlook on sectoral preferences. Thank you so much for taking time out and joining in. So much to discuss. Let's just first up understand how you're looking into the momentum that we've seen in the markets. The fact that the macros really seem to be supporting what we've seen at an index level. Do you believe that there's more steam left in the markets?
Good morning. Clearly, most market participants expected markets to remain quite range-bound, at least during this earnings season. So, to that extent, the kind of resilience that the market has shown and the breadth that we have seen over the past few weeks is definitely encouraging. I don't know whether it has still to make a new high at this point of time, but clearly, I think undertone remains quite okay. Overall, we are looking at an earnings season where it will be a marginal improvement as against the December quarter. Even as you look at first half of this earnings season, until now we have seen about a 20% year-on-year growth in terms of earnings. Obviously, this has been led by some of the frontliners. We'll have to wait and see how the broader market responds in terms of earnings in the second half. But broadly, I think we should be able to get a earnings growth, which is more or less near the market expectations.
All right, fair enough. Now you're looking at revival-linked themes in the markets at the current juncture. So Harsha, in light of that, what is it that would be on top of mind when it comes to looking at sectors at the current juncture?
Clearly, we have been positive on many domestic-oriented businesses. Clearly, domestic growth remains more resilient than global growth. Banking remains one of the top sectors across our portfolios. We have seen credit growth improving, asset quality issues have kind of subsided quite a bit. Overall situation for the banking system growth seems quite conducive, and we remain positive on this. In fact, this is one of the sectors which will have significantly higher earnings growth over the next 2 years as compared to the market. We are also positive on a few other domestic businesses such as industrials, auto, cement, etc. All of these pockets, we believe that there is significant growth ahead. And if we make the portfolio cautiously looking at the valuations within the sector, then I think there is definitely upside that can be captured.
Harsha, hi, this is Anish also joining into the conversation. Wanted to get a sense from you with respect to the auto stocks. The April sales data doesn't look very enthusing. Do you think the rally is likely to derail there?
To an extent, yes, the volume growth scenario hasn't panned out the way market was anticipating. But nevertheless, we believe that the supply side constraints, at least for the passenger vehicles, should improve over a period of time. And also, we are expecting gross margins to improve as commodity prices have really cooled off. So I think the benefit of these two things should start to come out in terms of results, maybe in the June quarter or in the September quarter. So that's when probably we'll see a bigger kind of a rally in the auto stocks. Nevertheless, I think at these valuations, these are reasonably priced, I would say.
What are you doing with respect to your weightage for the IT sector? Are you looking at reducing it, or selling out some of the stake there as far as IT pack is concerned?
It's been more or less a status quo for us. In fact, we went negative on IT sector sometime around last quarter of 2021. And since then, we have been maintaining an underweight stance. And clearly, this has been driven by a lower than expected global growth and also the kind of concerns that are coming in few verticals such as BFSI, telecom, etc. While there is still a debate whether some of the weakness that we saw is related to specific companies or to the overall sector, etc. But clearly, over the next couple of quarters, we believe that business momentum is unlikely to revive in a big way. To that extent, we remain cautious. And as I mentioned earlier, we believe some of the domestic sectors have better legs in terms of seeing better demand conditions, and also profitability margins should improve for most of these domestic oriented businesses. And hence, our positive view on domestic businesses continue, whereas the underweight stance on IT still holds.
I just wanted to understand your outlook as well on the whole as to, whether or not you see us falling prey to the concerns that we have overseas with respect to the kind of slowdown that we're seeing. Do you think that, that theme, that word rather that we used quite popularly a few months ago, that we're seeing a decoupling when it comes to the Indian markets, actually holds true, or we are likely to pretty much trend basis what we see across the globe, or the fact that our fundamentals back home are looking rather promising that we could chart our own course?
Well, I would say the economic growth continues to be much more resilient than what we are seeing across the globe. Even inflation trends have been much more moderate in our country, and we anyways have a positive real rate at this point of time. So to that extent, I think the monetary action in India will be a lot more calibrated as compared to what you are likely to see overseas. While this is true, I am not so sure whether one can say that we have completely decoupled in terms of the sentiments. I would guess that sentiments would still be driven by what's happening across the globe. Every now and then, we may also see the kind of knee-jerk reactions that are coming because of what's happening in US or in Europe in terms of economic data, etc. However, I think once the dust settles, I think our markets will have more legs to really go higher as compared to some of the other markets. And also, one of the other issues that we had to contend earlier was our relative expensiveness as compared to emerging markets or some of the other competing nations in terms of flows. For the last 4 or 5 months, clearly that expensiveness has got corrected quite a bit. And while we continue to remain expensive compared to some of the emerging markets, this expensiveness is more or less similar to what we have seen in the past as well. So to that extent, I would say our relative premium continues to be more or less in the zone that we have seen in the past. And that should enable more investors to look at India from a longer term perspective.
Okay, let's see whether those investors, foreign investors, look at India positively or not. But Harsha, wanted your sense with respect to how the market setup is, large cap versus mid cap. Of late, we have seen quite a bit of rally, at least in the month gone by, in the mid cap names. Do you think that's likely to be the case for the rest of the year as well? Or given the volatility we are talking about, it's better to stay with the large cap quality names?
We remain slightly cautious on the mid and small cap basket at this point of time. Clearly, the macro concerns are going to be a larger headwinds for this basket as compared to that for large caps. And also in terms of valuations, mid and small caps, despite the kind of sideways movement that we have seen over the last couple of quarters, their valuations seem to be slightly higher than that of large caps. While large caps have clearly been in the fair zone of valuation from a longer term perspective, one cannot say the same for mid caps and small caps at this point of time. And also the earnings volatility, as you rightly mentioned, could be higher for mid and small caps. So to that extent, while we are neutral on overall equity allocation, we would suggest a slight tilt towards large caps at this point of time. And maybe over the next couple of quarters, if there is more of time correction or value correction, or if there is better visibility in terms of earnings, then probably would be the time to look at increasing allocation to mid and small caps.
I don't see any pharma, stock or big presence as far as your top holdings are concerned in some of your portfolio. How are you positioning yourself with respect to the pharma sector?
On the pharma sector, we have been quite selective. There is no single driver that's driving the entire sector either positively or negatively. So to that extent, we have been evaluating companies on a bottom-up basis. And if you look at the overall cumulative weight of pharma within our portfolios across the board, yes, definitely it's an underweight. So to that extent, at this point of time, we don't see any big driver from pharma, apart from the fact that it has underperformed over the last 4 or 5 years consistently. There is no other single driver for the sector to really look at.
All right, what's the outlook on the capex theme? Because that really seems to be a story that a lot of market experts are building on. I assume you'd be positive on this space, but Harsha, give us a view as to how exactly you believe investors should play it, given that we've already seen that furious run-up play out across sectors like, say, railways or defense, and even capital goods like L&T to a certain extent.
Well, clearly, we have been very, very positive on the entire capital goods industrial segment. And we have seen overall investments into capital goods or engineering related companies going up significantly over the last few years, despite concerns like COVID, etc. There is also an export opportunity that's unfolding. So overall, the entire space seems to be seeing quite a bit of traction. If you look at the overall investments of private sector as well as central and state governments over the last 6 years or so, despite some of the hiccups like COVID, we have seen this number almost doubling over the last 6 years. And there is no reason for us to believe that over the next 5 or 6 years, this can this cannot move even higher. So to that extent, I think the runway for growth for industrial seem to be very, very strong. We have seen overall average capacity utilization going up towards 80%. And once it crosses 80%, we will also hear more of capital expenditures from most of the other manufacturing sectors as well. So to that extent, I think the overall space continues to be one where there is significant runway for growth. Yes, some of the valuations have discounted some of this growth. So that's where one needs to be looking at opportunities within the sector based on valuations, not just growth. And overall, I would say this space can still provide a lot of outperformance over the next couple of years.
Right. Okay, Harsha, we let you go on that note. So long runway of growth is available for industrials. Let's see where they head from here on. Appreciate you joining us on the show now.
Thank you.
Let's move on to the next guest. We have Mr. Ram Mohan Rao, the MD and CEO at SBI Card, joining us to talk to us about their earnings, because their revenue from operations was up 32% and quarter on quarter the profitability is also high by 17%. While the operational metrics look quite decent, sir, just wanted to get a sense as far as your credit cost is concerned. That's gone up by 77 basis point quarter on quarter. Understandably, of course, there has been an up move overall with respect to the rate hikes. But could you explain to us what we should expect in cost of funds going forward?
Credit costs, if we look at entire FY23, it stood at 5.9%, which is a 230 basis point improvement over the previous year. Having said that, but Q4 had a different trajectory where we ended with a credit cost of 6.3%. We carried out a kind of one-time adjustment to the model estimates, which elevated the credit cost during Q4 by 20 basis points. Adjusting for that, it will be like a 6.1%, which is broadly in the range of 5.8 to 6.2%, which we always guided in the past. We identified a small segment of portfolio, particularly from the legacy portfolio, which was showing higher delinquencies. We have initiated portfolio actions to reduce the kind of flow rates and also improve the write-off kind of performance. So these actions will be showing the result in the days to come. But the vintage, or the latest vintage, or the sourcing what we have done since 2020, it's holding good. It is behaving as per the expectations in terms of delinquency. So the actions initiated by us will start showing the result after a quarter.
All right. Good to have you on board. Thanks so much for joining in. I just want to know the outlook on credit costs. Where are they likely to trend, and where do you think that we could see it trending towards the lower end of your guidance?
So normalizing it for this one-time adjustment, it is at 6.1% for Q4, which is broadly in line with a 5.8 to 6.2% what we have guided in the past. We analyzed the problem at our end. We looked at which segments of portfolio are showing higher delinquency as compared to the portfolio average. We undertook a lot of portfolio actions on this portfolio. It will take a quarter to show, for the credit cost to start declining. But we will continue to operate in this tight band of 5.8 to 6.2%, maybe at the upper end of this band for a quarter before we start actually showing a improved credit cost performance.
Okay, and is the higher cost attributed to older customers or the customers acquired post-2021?
The vintages, latest vintages are what we call the sourcing done from the COVID period is behaving normally as per our expectations in terms of the standard delinquency kind of a band what we used to observe. The problem is with a small segment of the portfolio from a legacy, that means pre-COVID period. So we identified, we sized up the problem, we initiated actions. These actions will start reflecting in the days to come.
And given that the industry has been seeing, the low revolver mix, can you tell us how that's looking like in terms of your credit costs? Will the mix start showing better results going forward?
At SBI Card, the revolver behavior is in tune with the industry broadly. We have been taking a number of steps to encourage or get a kind of customers who have a higher propensity to revolve. We are permitting higher share of self-employed, even new to credit card, the kind of customers who have a higher propensity to revolve. For the first time in this quarter, we have seen the revolver portfolio growth has been in tune with the general portfolio growth. That's the reason it's stabilized at 24%. It will be difficult to say what will be the trajectory, when will it improve. But in terms of taking steps that are required, we are taking right type of steps.
Sure, but even though your market share of cards, in force is rising, your growth of cards in force is not as quick as the spends growth. Is that a concern?
As you know, the spends is a play of both retail as well as the corporate card spends. During FY23, our retail spends have increased by 41% year on year at a very healthy rate. We have seen a kind of improvement across broad categories. Even the per card spends, retail spends have increased by 9%, despite the card base increasing by 22% during the year. So this is because of our constant efforts to improve the customer engagement and deliver a better customer experience. These are helping us to keep the retail spends at a healthy clip. But overall, market share is a function of both corporate card spends and retail spends. We guided in the past that corporate card spends is more of a top-line game. It will be less accretive to the bottom line. We want to play in this space in a calibrated way. We guided in the past that we would like to keep the corporate card spends in a narrow range of 22 to 25%. We continue to do so. While we will look for efforts to ramp up the spends, we will also be mindful of the bottom line impact. So the efforts what we have undertaken so far will help us in terms of slowly bridging the gap between the cards in force market share and the spends market share.
And at the end of the last quarter, you suggested that your net interest margins will improve. But given that the pressure continues, what's the outlook for FY24 on your net interest margins?
Last quarter, that is a March quarter, the cost of funds increased by 39 basis points. Predominantly, the funding happens through short-term working capital lines, what we avail from the banking system. 65% of the funding happens through the short-term liabilities, while 35% is funded through long-term liabilities. But we were able to transmit this rate increase largely in terms of new disbursals, which helped us actually absorb this cost of fund increase. So that's the reason we were able to maintain NIM at a stable rate of 11.5%, which is only 5 basis points lower than the previous quarter. We are confident for the kind of steps what we are taking in terms of transmitting the rate increase for new disbursals. We are confident that NIM will stabilize over the next 2 quarters.
Okay, on the cost side as well, the fees and commission expense has gone up quite sharply. What is causing this sharp rise, and will it continue in that direction going forward as well?
We talked about the robustness in the retail spends, which adds to the fee income or the interchange income. Similarly, increased corporate card spends will also add to the fee income. Particularly during the last year, from 1st of October, when the regulatory directions had some adverse impact on certain revenue lines, we found a couple of opportunities to partially supplement our fee income. We levied a fee on the rentals. We revised it again in the month of March. We increased the processing fee in respect of EMI transactions. All these have helped us to keep the share of fee income and the commission income at a robust level. So we are expecting a robustness in the spends to continue in the days to come. So will be the case with the fee and interchange income as well.
Okay, and give us a sense as to what the outlook is, given that there is now talk of credit through UPI. Will that really affect the business for SBI cards? Will this new revenue stream be built around this?
Industry already offers various products, particularly through the digital means. Banks and NBFCs offer unsecured loans, BNPL, etc., through digital means, completely end-to-end digital. Banks also offer debit card-based EMI programs. So that way, this is not a dramatic change, accepting the fact that it is a convenient way to avail the credit. So it's a better user experience, better way of availing credit, but it's not going to change the game dramatically in terms of competitive intensity.
Okay, so we'll let you go on that note. Thank you so much for making time and speaking with ET now. But time to move on and talk to the management of RVNL. That stock has been on a tear of late. In fact, in the last 5 days, it's up as much as 30%. In 1 month, that stock has rallied 55%. And for the year so far, we have seen a solid rally of almost 70% on the counter of Rail Vikas Nigam. So that's the kind of, shareholder value that stock has generated. Let's welcome on board Mr. Pradeep Gaur. He's the CMD at Rail Vikas Nigam Limited. Hi, sir. Good morning. Thank you so much for making time and speaking with us. Mr. Gaur, the latest is with respect to the company getting the Navratna status as well. Could you talk to us about what would it mean for your operations? Will this improve, let's say, the cost at what you borrow? Will it help it lower it? What are the other operational benefits that you get with this status?
Yeah, thank you so much for having me on your show. The Navratna status for us, it's a very big thing for us, and it will, in the present ecosystem in which we are working, it will give us a huge impetus in various fields. So the first and foremost is it doubles our delegation to invest this thing. It empowers board to invest in a single proposal to 1,000 crores as compared to 500 crores earlier. So it helps us in formation of SPVs when we are going for HEM models. We are going for SPV for creation of SPVs for forays into foreign markets. To that extent, it's a huge plus for us. Secondly, the Navratna status allows us to even acquire various assets even in foreign countries. So that will be a big plus for us when we are foraying into the foreign market. It gives us a whole lot of maneuverability to do the things. And third, and not the least, is it allows us a lot of freedom for in HR sector, particularly when we are looking for new talent in view of our changing business opportunities. So to that extent, it will give us huge impetus. And the fact of Navratna status and the lot of freedom what it gives us to invest, it will give a lot of confidence to the banks and this thing when they deal with us. So I'm very sure it opens a huge vista of opportunities for RVNL. And the way RVNL has performed over the period, I'm sure we are looking for very, very exciting and vibrant times for RVNL.
Okay. Mr. Gaur, you talked about how the Navratna status is going to help you with respect to, bidding for foreign orders, etc. as well. Could you talk to us about what the, export exposure is at this point of time? Could it go up to? And secondly, with respect to the banking confidence you talked about, what's the cost of borrowing at this point of time? What could it lower to? What will it do to your interest cost?
Yeah. The first and foremost regarding our forays into the foreign market, we are already working in a very big project in Maldives. We have bid for a few more projects, and we are very hopeful to get it in the countries in the same region. Secondly, we have established our office at Dubai in the Middle East, and that will be our fulcrum to do a lot of projects. A lot of projects are in the pipeline in Middle East and even in Africa. So I'm very confident in very short time to come, you will be seeing RVNL expanding its footprint and stamping its presence in many countries. As far as the banks are concerned, see, once the banks come to know that this company, one thing, of course, it is performing. And second thing, it has been further delegated powers. And the government of India has reposed confidence in it by granting it a Navratna status, which means more delegation to us, automatically makes banks more comfortable. So presently, a lot of SPVs, what we are having, our interest rates are around 8.5% of the borrowings. Definitely, we'll be in a much better position to negotiate, and the banks also will be willing to have a better look in towards us with the kind of delegation and the kind of confidence they will have the way we are performing.
No, Mr.
Ultimately,
Mr. Gaur, just a sense, 8.5% is the current cost of borrowing, and I just want to understand, usually when this status upgrade happens, what could be the impact? 50 basis point lower, materially lower, just to get a sense as to, where we should see the cost of borrowing going forward.
Whatever money is the borrowed, I don't think it will have any impact on that, because that is what we have already entered into the agreement. But we are going into a lot of HAM models in national highways or formation of SPVs like for train sets, what we have got a big order. So when we negotiate with the banks, definitely the financing cost will definitely be, I think it will be much more favorable compared to what we have been getting till now.
Mr. Gaur, hi, good morning. There's a lot of news triggers, but one of them being the fact that the company has emerged as the lowest bidder. This is for the maintenance of the Vande Bharat trains along with a JV with a Russian company. Just walk us through the kind of order potential this is going to bring and what is the timeline in terms of the execution update?
Yes. So our foray into this field, which was entirely new for us, it's a big, huge plus for us. Now the timeline is we have been given the order to it is not only for maintenance, it is for even manufacture of 120 train sets, Vande Bharat, which will be manufactured at Latur. It is a factory which was established by Arvinal itself. So it's one is we are in a very advantageous position to do this. Second thing, this project or this contract also entails maintenance for a period of 35 years. So it's a big order. The present financial cost comes to almost around 34,000 crores. And Arvinal, being a PSU of the ministry and the kind of manpower it has, and its licensing with the various organizations in the railways and even with the railway board will put us on a very firm pedestal to not only to execute this project in a most efficient and a cost-effective manner. So we are very, very upbeat about it. And I'm sure in the time to come, you'll see a lot of Vande Bharat coming out manufactured with the assistance of Arvinal.
Okay. And just to also get in a sense, as you've emerged as L1 for the CMRL Phase 2 project, that's the Chennai Metro Rail, can you walk us through the kind of potential in terms of orders and what does your total order book stand at and the outlook on that front?
Yes. So this is something very remarkable and I'm so proud to share with you that almost 1.5 years back, nobody would have imagined that Arvinal will be doing now metro projects in 3 major cities of the country. That is Chennai, Indore, and Surat. So we are major players in all these places. As far as Chennai is concerned in particular, now the Corridor 3, now the major presence in Corridor 3 will be of Arvinal, with the 3 underground projects, and already we are doing work on 1 elevated project. So it opens us to new kind of work, exposure to new type of technology and this thing, which will prime us up to not only execute very challenging metro projects in India, but it will make us to look for these opportunities even abroad. So it's a game changer for us. And this is the first time we'll be doing underground metro, because whatever metros we have been doing till now were all elevated. So it's an entirely a new field for us, a challenging field for us, and we are very confident of coming out with flying colors in this.
Okay, so Mr. Gaur, just quickly wanted a sense from you. I understand that your revenue trajectory was close to 25,000 crore per annum. What is it likely to be in FY24? And what about margins? Are they likely to head northwards?
Yes. So as far as this turnover is concerned, definitely we have been growing at a CAGR of around plus 27%. So we are sure of maintaining the same. So we will be doing it. Now, of course, earlier we were primarily dependent on Ministry of Railways for the projects. Now the opportunity opens up for us much more in so many sectors. Now it is up to us how much we expand, how much we are able to deliver, and this thing. So there's no limit to it, and I'm sure we'll be not only be able to maintain what we have been doing, we'll be growing it further.
How much, and what about the outlook on margins, the number?
Margins, definitely, till now the margins used to be fixed margins because of a particular model of projects with the railways. Now the margins will be dependent on how efficiently and how timely and what type of innovative technologies we use. So definitely, I'm very confident because this organization, Arvinal, has got huge technical and managerial strength. So this is a time for it to unleash that in the new sector. And I'm sure the margins are going to improve only on what we have been seeing till now.
We let you go on that note. Thank you so much for joining us and talking to us
Thank
about the prospects. So, looks quite strong with respect to the order books. The revenue visibility is quite strong, and the management believes that 25 to 30% CAGR with respect to revenue growth is possible over the next few years as well. On that note, we are slipping into a very short break with the news that the market is holding steady, 18,124 at the Nifty.
Welcome back. Thanks so much for staying on with us. Let's bring on board Mr. R. Subramani Kumar, who is the MD and CEO at RBL Bank, to talk about the earnings gone by. Thank you so much for taking time out. Let's start off by talking about that loan growth, because that has been healthy. Do you think that we can see this loan growth rate continuing to grow? What's the target for FY24?
Just to set the context to you, I would like to recall that when we just met a year before or 9 months before, I was just telling them that our intention is to grow the credit to the tune of around 15% and retail to the tune of around 20% on an annualized basis. So we have just exited the year, rather the annual growth for retail was 21% and annualized growth itself is 24%. Sequentially, we did around 8%. And overall credit growth has been 17%. This was primarily triggered by 3 different strategic changes which we did, our approach, we planned it out in the last 1 year. Going forward, that will continue to be play out. One, we said, we will try to play to our strength of credit card and microfinance. Microfinance was not at all taking off earlier years. Now we have started moving up. So that grew around 25-26% than what the quarter on quarter, and ultimately from negative growth of 36% is now come to the positive territory. Second was a credit card which continues to grow at around 24%, which we are year on year. Addition to that, we have moved our wholesale book to the commercial book, the corporate book and commercial book. We said that we'll balance it. We'll have a better growth in commercial banking. Commercial book also show a growth of around 19%. And housing loan, LAP loan, and few other retail products, we said we'll be launching it. Two-wheeler, our vehicle finance, rural vehicle finance. Rural vehicle finance touched the milestone of 1,000 crores. And the commercial, our housing loan has really trended well with 88% because low base. It is not fair to tell about the statistics. But what is interesting to see is that housing loan, LAP, both put together was able to give me an 806 crores of last month growth. That is one. The second, housing loan per se itself has grown by 900 crores in last quarter. So these things will continue. In addition to that, we will have a two-wheeler, used car four-wheeler, then we will be having gold loan, we will be having educational loan, we will be having SME loan. We are coming with the BBG, that's a business loan. All these things are in the form of being underway now, and it may start delivering from Q2 onwards. With all these things, we are gaining around 20% growth is the minimum what we are looking at. We will be able to grow 20 plus, which in the retail will grow around 25%, and overall growth will be around 20% in advances.
Hi, sir. This is Anish also joining in the conversation. Your credit costs are at 1.5% for FY23, and in Q4, it was 0.29%. What kind of credit costs are you targeting on the incremental book, and what is going to be the normalized run rate going forward?
See, if we just look back for the credit cost, we had it, our intention is only one. When we are going for the retail as well as the credit card, Nahir is one. We start the day with the collection, end the day with the collection, in between do the business. This is the model we have been working on. So when I do that particular activity, the primary focus is to arrest the slippage. That is the primary focus. We have a very strong monitoring team, apart from having a good underwriting team also. So what last quarter, we closed it with around credit cost of 29 bips. The previous quarter was 39 bips. And the entire year, the credit cost was 149 bips. If you recall that we said in the beginning of the year that our credit cost will be less than 50% of what we did with the previous year. In fact, we did much below that. So going forward, we will continue to do around 1.5 to 2% because you can't go below that the level of 29 bips what we have done it now. So the intention is to hold it there. At the maximum, we will be in the range of 1.5% to 2% credit cost going forward. That's one. The second, when we are talking about this, we have made the recovery of our technically written off accounts. That is also one of the big focus we have brought into the bank. So last year, that's the year which we concluded now, we were able to make a recovery of 103 crores, which also brought down the provision requirement by 103 crores. Going forward, that is also going to be the big focus for the bank for recovering out of the technically written off account. That's otherwise 100% provided accounts.
And take us through what the outlook is on your recoveries going down the line. What number could that be at for FY24?
What we have achieved now, and it will be definitely 10-20% more than what we have been doing it.
Okay, so that was about recoveries, but what about deposit growth? Because that's been strong as well. How should we expect that to move? Because 4% sequential is healthy, but the question is it sustainable?
One important thing I need to tell you is that the space in which we operate, necessarily the differentiator has to be the rate of interest. We are not the giver of the rate, we are the taker of the rate of interest as far as our bank is concerned. Going forward, that is continued to be the one. We will be a differentiator in terms of higher rate of interest, unless otherwise the rate cycle reverses. We will continue to have rate of interest the same range what we have been doing it. If not a higher rate of interest for the FD and other things, we will continue to incur our high cost for the deposit because all the deposits are already locked or locked up in the current rate of 7.8% plus. So these rate of interest, it is going to catch up. It is not going to reduce even if the rate cycle reverses. So we will continue to be increasing our cost of deposit by around 40 bips will be the one which will be the increase as far as next year is concerned. However, this is not a great concern for us and it may not impact our NIM for the simple reason that we are diversifying our credit portfolio instead of anchoring on three. That's a corporate, credit card, and micro banking. Now we have just gone ahead with so many other retail, which is giving me extra margin which we are missing it out in the corporate. So we will be able to maintain that NIM of around 5% going forward as well.
All right, good to have you on board. Thanks so much for taking time out and joining in. That's the management highlighting the road ahead, also talking about how they are looking at a PAT of about 2,600 crore rupees. They are looking to expand their branches and 2.6 lakh crores of business is what the management is looking to clock in. RBL Bank continues to languish in today's trading session. But we've got a stellar corporate lineup for you. So let's move on then from one corporate to another. Vivadanathan is the Managing Director and CEO at IDFC First Bank and joins in to talk about a pretty stellar Q4, what the outlook is when it comes to their loan growth momentum and whether or not they can sustain their margins. Thank you so much for taking time out and joining in. Let's hear it out then from the management speaking with Nikunj.
Yes, indeed, Nikunj, I remember that walk the talk, so to say, show with you. And there were certain things we discussed there. I'm happy to say every one of them is playing to the plan. It's actually not about a blowout or a fantastic quarter. If you think the trend over the last 3 years, that's really very important. The trend line is strong, which actually augurs well for the coming year. One of the key things to watch out, of course, we had a fantastic profit at 2,400 crores of profit after tax this year. This is great. We feel good about that. But more importantly, something important is that the loan book grew by 24%, but operating profit grew by 67%. So really, what does that tell you? It tells you about good operating leverage kicking in.
So is IDFC Bank now entering what could be called as a strong phase of loan growth, and the drag from the wholesale business, which in a sense had haunted us in the past, that is behind the bank?
More than a strong phase, I would say a steady phase of growth, because we believe that about a 23-25% growth rate we should sustain for a long time. Last year also was 24%. And considering that, most banks, I'd say, are posting about a 20% growth rate in retail, 24 for us, coming from a lower base, should be reasonably possible. But, more proud than a phase of growth, I'd say is that we are really very proud about our asset quality. And it shows in the gross NPA, net NPA, all that.
Currently, there is a fight for liabilities, and despite this fight for liabilities, where big banks are trying to gather more deposits, your deposits have grown 37% year on year, 9% quarter on quarter. Very impressive number. Will it sustain? Will you be able to generate this kind of a liability?
Actually, that has been, you're right, that has been our, let me say, our most defining strength over the last few years. Our bank is really very good in getting deposits. There are branches, there are network. Customer products are quite customer friendly. We focus really a lot on customer service. Like we go crazy about it, and we put a lot of systems and controls and tracking and monitoring and feedback loops and correcting our systems. So we put a lot of effort in customer service. Brand has come really well, by the way, Nikunj. People think of a brand as a good, clean bank. So all of these things play a role in deposits. We feel these are sustainable factors with the service or brand. Next year, last year actually, deposits grown by something like about 44%. Even if you took out the one-off income, one-off deposits of 2,000 crores we got during the end of the year. So this year again, 40 to 45% growth you should expect from us, and I think we'll do it.
So what you're guiding for is a 40 to 45% growth for FY24. But what about FY25? Do you think this growth, what you have now registered, it will not be a multi-quarter phenomenon? It could be a multi-year phenomenon?
Yes, it could be a multi-year phenomenon, because if you see last 4 years also at a stretch, our CAGR growth and deposits is something like, at least retail is upward of 70%, which I'm now talking of 40%. I'm talking of slowing down. But still it's good, like 40%. Yeah, even 25, 26, we feel the bank will be very strong in deposit, because frankly, deposits not that difficult as it's made out to be. Because one is, of course, we're an early stage bank. Secondly, if you need more deposits, you just need to put up some more branches, go to new territories that we are not present in today, or open more locations, and you're in. So you should expect it from us that we'll do stronger deposits every year.
Your cost to income ratio, historical factors, have in a sense been a bit of an issue. Now that operating leverage has kicked in, do you see a marked improvement on that, and do you also see a marked improvement going forward in terms of your ROE now?
You see, last 4 years, cost to income has come down from 95% down to the 80s, then mid 70s. Now we're down to 72. So it's pretty clear how that is headed, and you should expect it to come down from here in a steady manner. There are two reasons which is easy for you to understand why it will come down. A credit card business is currently loss making. It is posting, the cost is more than the income. But by 25, we expect that to reverse. We expect credit card business to be firmly in profits, and cost and income to be more than costs. So that is one big swing, and other is, of course, the legacy liabilities that's going to reprice. It should come down.
One of your biggest naysayers has been Morgan Stanley, and I was reading a report that Morgan Stanley also has changed their view on the bank. Does it feel good that now finally there are no naysayers left and everybody has a buy on IDFC Bank as a stock?
No. First of all, it's good to have a few naysayers. It keeps us grounded also, and makes us, come back with greater charge to achieve something. But having said that, yes, frankly, I always felt that Morgan Stanley never understood a business, because they were just taking a ROE and putting on the grid and coming out of the valuation. They always called a stock of 34 rupee stock or 20 rupee stock, etc. But now that they've come back to 70, means one of our biggest, so to say, bears or analysts who didn't believe in us have come back with a positive glow on us. Yeah, it feels good. Actually, we were very confident of the business model. We were very confident. We were sure if we do our job, it will show. And I'm thankful they changed their mind.
So how will FY24 be different from FY23?
As the bank begins to now grow, what happens is that we will have two engines that will begin to fire now. And in 24, we expect that phenomenon to play out. What we mean is that, if you see most large banks, including the big ones that we know, they have a large base of deposits and customer assets, etc. So existing base also gives them business. New business also gives them business. For us, because we're a new bank, we did not have existing base. We only had to hit runs from the new customers. So going forward, we expect that existing base to also give us deposits. We expect, of course, new to bank. So I think it will get better for us because of this phenomenon.
So as we look into the future, in terms of technology, in terms of adaptation, are you working on something which could, in a sense, give you a edge or a lead over others?
See, on the technology front, I think we are making every effort to be, let me say, cutting edge. And more important than cutting edge, we are trying to be in sync with the new ecosystem. For example, in bureau, we are plugged into the number of bureaus, so we get a full profile view of the customer. There is the new technologies of AI ML that are coming in underwriting. We are using those capabilities. We have developed a really good data stack so that we can get a good customer view of the customer. So the entire stack of the infrastructure layer, the application layer, the middleware layer, the engineering layer, let me say the channels, the customer, the whole stack we are really building well. And I think we have some advantages, yeah.
So just to wrap it up with one final question, in the course of last 2 weeks, we've heard comments from other big banks also. Big banks are talking about moderation in credit growth, but what you're indicating to us is a completely different picture. What you are indicating to us is that the bank is firing full cylinders and FY24 will be another year of high growth.
I'd say moderate growth, actually. No, I'm not, by the way, very different than others. If you see, the whole banking system is talking of a reasonable growth. You see, like between 17-20%, everybody's posting. We're talking of maybe 23-24. So I wouldn't say I won't take those credits the way you're saying it. But I'd say that on the deposit side, of course, we expect to be continue to be very strong. That is one. Two is that I'd say that all the work over the last 4 or 5 years from my predecessor's time in building the bank and time, all that will come to fruition. We must have lost 2 or 3 years because of some issues here or there on a few things, COVID and bad loans and all that. So, but I think that phase is behind. If you look next 5 years, you should be, let me say, pleasantly surprised. You'll forget the past.
And as of now, even though you're growing for IDFC First Bank per se and for the sector per se, you don't think that there is an NPA ripple?
Look, we track one thing and we are very particular about it, okay? And that is what is our collection percentage on our primary bucket. Now, our collection percentage, and we report it publicly, by the way. We report month on month, not quarter on quarter. We report month on month collection percentage. Now, we are collecting 99.5 to 99.6% consistently. If you collect 99.5, only 0.5% moves to 0 to 30 DPD. If we sustain this, we are determined to sustain this. Our net NPA numbers on retail is 0.55%. Our gross NPA in retail is 1.55%. So we are very clear that we will not want to leave asset quality as an issue. And of course, we have to be very watchful for that, but we will be.
Okay, so that was the conversation of Nikunj with Mr. V. Vaidyanathan. For now, the stock is holding up comfortably given the fact that the earnings were quite better than what Street expected. In fact, for the market as a whole, 18,200 seems to be on the card at this point of time. 18,175 is where we are at. A lot of stocks doing well. Tech Mahindra, for instance, is suddenly up around 3 to 4%. You also have a lot of these textile companies, retail companies, which are doing well. Welspun India is up 12%. You have TCNS Brands, which is up 7%. Shoppers Stop has piled on gains of 5%, and then you have other names like VIP Industries, etc. as well, which is up anywhere between 4 to 5%. So this entire space seems to be buzzing. RVNL, we just spoke with the management. The stock is already up 70% this year. The traction continues on that one. And I also want to flag out Atul Auto because that stock is down 9 to 10%. The auto sales data was very weak for the company because the April sales is down as much as 55% year on year. And Hero MotoCorp as well as Tata Motors are on the back foot. So entire auto space is on the back foot, while the likes of textile and some select names from IT, etc. are doing well in the trading session as of now. But moving on and talking about another result reaction, and that one is coming in on Mahindra Finance. We have with us Mr. Ramesh Iyer, the MD and Vice Chairman, joining us to talk to us about the earnings. Well, we saw 50% growth in disbursements in the quarter gone by, but going ahead, there's going to be erratic monsoon in the country. People are talking about El Nino, etc., as well as the FMCG are talking about some stress when it comes to the rural economy. What's your take with respect to how the disbursement growth is likely to be?
If you look at last about close to about 8-9 quarters, we've been repeatedly saying that the rural sentiment is positive as far as we concerned. And the reason I'm saying that is most of the vehicles or tractors that we finance are all put to use and they earn out of them. It's like a lively product for them. And therefore, what we have seen is a need-based product in rural is doing extremely well, and we continue to see that. We are continuing to see demand for pre-owned vehicle, which again is a reflection of that the need for vehicles to be put on road for their earnings, because the tourism is doing well, people movement is good, infra is doing well, and therefore we don't see any pressure out there. In as far as you refer to the monsoon part, I think the overall report does say that the monsoon is expected to be around average. What one has to wait and see is how widespread they are and how they are relevant to some of the states where it is important. And we do believe that that should do well. And the water levels are pretty good. Even the yield that we just saw, and I think all of us have seen, even the wheat purchases have been pretty good. So we are very comfortable to believe that the rural sentiments will hold up, and the next 2 or 3 years would see a growth for at least the segment that we are representing.
Now, overall sentiment looks good, but can you highlight the pockets that are doing well and those where you're feeling a pinch? What's the outlook, Mr. Iyer, in terms of which loan segments could really drive the growth going forward?
I think clearly we have seen growth across the country without exception in every state and almost every product, which is why, cumulatively we said that the sentiments are very, very positive. We have not seen any pressure in any segment, at least at this stage, and we continue to believe that they would not do well. I think I would like to remind that we are playing in the largely earn and pay segment, and that's a reason a couple of years back we had pressure when this segment was not doing well. Currently, we see almost all vehicles, tractors, everything is fully deployed, in fact, to their full capacity, and we don't see any pressure on that front, and we continue to believe we would do well. In as far as the personal segments are concerned, we have entered the affluent customer segment, and we are offering very competitive rates out there to be able to compete, and that's helped us even gain market share. So you should overall understand that the segment that we were largely present in is doing pretty well. The new segment that we have entered into, we are actually gaining market share. And then thirdly, we have added new product lines like SME, LAP, etc. The three things together is what really driving the growth, and we don't see any concern around that.
Okay, another standout in your earnings this quarter was the asset quality, which has also improved quite meaningfully, and also provisions have fallen sharply. What are the factors which are driving this improvement, and what about the road ahead?
Not necessarily. I mean, see, these are not arising out of new loans that have been lent, right? This is the decreasing trend of NPA is largely out of the existing book that we have, which means these have all been lent already a year, 2 years back. Clearly, please understand, and this has been repeated by several times, the earn and pay segment, when they don't earn, there is always a pressure, and therefore you will build up happen. Now that we are seeing good earnings for these customers, these are all very genuine customers who were hit circumstantially a couple of years back, and therefore the delay. Currently, they are all earning well, and therefore you can see their intentions to repay very, very clearly. I think it's also important to understand that various support has been provided to our own teams on the ground. Wherever there are customers who are earning but are not paying, we call them as the intentional defaulters. I think we are reaching out for a settlement with these customers. We are using legal tools, and therefore you will see an overall improvement. But fundamentally, it is an outcome of the positive earning sentiments in the rural market. And my last comment would be, whenever the business does well, the collection is bound to do well, because it's an overall reflection of the improving cash flow. Because when somebody buys a vehicle, they do bring in 25% margin money, which means they are able to bring in 2-3 lakh of rupees upfront. That is nothing but a clear outcome and the visibility of the improving cash flow in the rural market.
So what is the asset quality target that you have in mind?
So if you look at our book, if you look at our new book, they are trending at a very, very low NPA levels of sub 2%. And as far as the current book is concerned, that is the past lending book is concerned, that's come down to a 4.5%. And the net is just 1.9%. So therefore, we would resort to aggressive settlements with customer. Wherever there is requirement to take back the assets, will be more than willing to take back the asset and transact all them. So I think one has to look at the book from two angles. The existing book of 4.5 definitely will show declining trend through settlement mode. And as far as the new book is concerned, they are sub 2%. So the overall NPA levels as we see going forward would be much lower than where we are if you take the average of the two added.
Sure, that point is taken, Mr. Iyer. But in a rising interest rate scenario, what's the quantum of rise in cost of funds you're expecting in FY24, considering the liability mix that you have?
So, fortunately, we run a very good ALM. And therefore, even in the last one, when we saw 200 basis point increase, for us, the impact was only about 60-70 basis point, which was mostly passed on to customer. Even going forward, I think we would see an impact of maybe a 25-30 basis point that could come in because of the liability mix changing. But we also believe that in the next 2 quarters from now, one could see a declining borrowing cost. And that if happens, this 25 odd basis point would get offset. The other two factors which actually have helped us, that we got upgraded to AAA recently, and that has helped us 20 basis point in some of the instruments that we borrow, which brings in a overall benefit of maybe about 10 basis point for us. And the last point would be many of our assets qualify for PSL, and we do offer them to someone who requires a PSL asset, and that gives us another rate benefit. So put this all together, we have been able to offset the increase to a larger extent given our ALM mix as well as the mix of product that we have. And I think we don't see a pressure on margin on account of borrowing cost. And if there was so, maybe a 25-30 basis point over a period would get passed on in the next year.
Right. And given that your OPEX has shot up as you're investing in technology and processes, when do you expect your OPEX to normalize? And when will the leverage of these investments actually start playing out?
So, technology investments, etc., or even investment in people training, etc., are a long-term benefit that we are looking for. And we expect that our current OPEX may come down to a 2.75 in the next 3 to 4 quarters or maybe a little more. We are consciously invested in that. And the returns are factoring that this would be the cost of operation for at least another 3-4 quarters. So we're not in a hurry to push that, but clearly there is a view on certain expenses which are not required to be incurred once that we have invested in technology, which should be definitely looked at. But will we see a cost of OPEX come down very, very fast? I think it's a sensible and a well thought through investment, and we would not expect them to come down very, very fast. But in the next 3 to 4 quarters, you will see benefit of all of this.
Okay, Mr. Iyer, on that note, we'll let you go. The stock is spiking 5% as we speak. The commentary regarding the way forward is also quite impressive, and that's the reason we're seeing the reaction on that counter. So the stock holding up 5% higher as far as Mahindra Financial is concerned. Overall, the market texture is also quite exciting at this point of time. 18,200 seems to be on the cards. It's the Bank Nifty as well, which is doing its bit. We are seeing a gain of almost, 200 points on the Bank Nifty, as well as the broader markets are looking quite positive with the advance decline ratio firmly tilted in favor of advances. But on that note, we'll slip into a very short break. Don't go anywhere.